This video is for educational purposes only and is not financial advice.
All right, let's get right into it. Today, we're talking about a really big shift in policy that's happening at the Federal Reserve. And this is a change that could have some pretty major ripple effects across the whole financial system. And you know what? It looks like it's happening a lot sooner than most people thought.
So the big question we're going to tackle is pretty simple. Why? Why is the Fed suddenly changing course? What's the real reason for this pivot, especially when the economy isn't, obviously falling off a cliff? Let's look at the clues.
The signs that this shift is coming are getting clearer and clearer. We're starting to hear top officials at the Fed talk pretty openly about a new direction, and the timeline is starting to look less like a maybe and more like a when.
Now, take a look at this quote. This is what's so interesting. This isn't your usual, vague, hard-to-understand central bank language. The New York Fed president, John Williams, is basically saying it out loud. The days of shrinking the Fed's balance sheet are numbered, and a new chapter of expansion is right around the corner.
And here we go. We've got an official date. The policy known as quantitative tightening, or QT for short, is officially ending on December 1st. This is it, the formal end of the Fed's program to pull money out of the financial system. Now, to get why this is such a big deal, we've got to be clear on what these terms really mean. So let's quickly break down the two big tools the Fed has in its toolkit, QE and QT. Understanding the difference between these two is absolutely key to getting why this policy shift matters so much.
Okay, so here's the bottom line. Quantitative easing, or QE, is what people often call money printing. It's when the Fed is pushing the gas pedal, injecting a ton of liquidity into the system to get the economy going. Quantitative tightening, QT, is the exact opposite. It's the brake pedal. It's designed to drain money out of the system, mostly to cool things down and fight inflation.
And this little timeline just lays it all out perfectly. Back in 2020, to fight the economic fallout from the pandemic, the Fed went into massive QE mode. Then, starting in 2022, it slammed on the brakes with QT to fight off all that inflation, shrinking its balance sheet in a huge way. And now, here we are at the end of 2024, and that whole tightening process is coming to a halt.
Which, of course, brings us right back to our main question. If the economy isn't in a nosedive, why stop tightening? The reason actually isn't about juicing the economy. It's about something much more, fundamental. The main driver here is to protect the stability of what's known as the financial plumbing. Just think of it like the pipes and drains behind the walls of the entire banking system. You never see it, but if it breaks, you've got a huge mess.
So this plumbing is basically the whole network of bank reserves and the critical repo market, where banks lend to each other overnight. It's the stuff that keeps the money flowing. But QT has been draining the water, the reserves, from these pipes. And if those reserves get too low, the plumbing can get clogged, and the whole system can just seize up. We actually got a scary little preview of this back in 2019. And this isn't just some abstract theory. You can see right here from Dallas Fed President Lori Logan. She's saying that rising repo rates, which is a huge warning sign of stress in the plumbing, would force the Fed's hand. They'd have to jump back in and start buying assets, which is just another way of saying they'd have to start pumping liquidity back into the system.
Okay, so the Fed is stepping in to be a plumber and keep the system from breaking. That makes sense, but what are the potential side effects of doing that? What could this mean for the markets? Let's walk through the potential chain reaction. See, even if the Fed's goal isn't to pump up the economy, the effects can be pretty similar. When the Fed adds liquidity, that can push down real yields on safer investments. And when that happens, financial assets like stocks can start to look a whole lot more attractive, which could push their prices higher and encourage people to take on more risk across the board. This kind of situation has led some really well-known investors, like Ray Dalio, to raise a flag. His view is that when you pump more liquidity into an environment that already has high asset prices and sticky inflation, the Fed is taking a big risk of stimulating into a bubble. So, the theory here is that this could lead to a kind of melt-up scenario, where all this new money just pushes asset prices up, up, up. The danger, in this view, is that the party keeps going until inflation gets so bad that the Fed has no choice but to come in and just slam on the brakes, hard, potentially causing a really nasty crash. Now, as if all that wasn't enough to think about, let's throw one more long-term factor into the mix: a potential change in who's running the show at the Federal Reserve. The current Fed chair, Jerome Powell, has a term that ends in May of 2026. This is a big deal because a new chair could be appointed, and they could bring a totally different philosophy on how to manage the economy. Based on the commentary on the source material, a new chair could lead to a more dovish Fed,
And what that means in simple terms is a Fed that might be more willing to let inflation run a little hot, more eager to cut interest rates, and just generally more focused on supporting growth and providing liquidity.
So, given this really complex picture, the source material lays out a few strategic points to think about. First, the idea is to follow the liquidity flow, since that's seen as the main thing driving markets. Second, the suggestion is to build positions when the market pulls back, not to chase huge spikes. Third is diversification. And finally, a big word of caution on using margin debt, because sharp drops can completely wipe you out, even if the market is generally going up.
And all of this leaves us with one final, pretty big question to chew on. You've got this mix of new liquidity coming into the system, market dynamics that could create a melt-up, and the real possibility of a big leadership change at the Fed. How are all these powerful forces going to come together to shape whatever the next economic cycle looks like? Thanks for watching this update on 15 Minute Investor.